Hey, we got a lot to talk about regarding Twitter and Tesla stock. But first, if you're an accredited investor, I seriously want to invite you to what I think is an amazing opportunity to get founder shares in HouseHack. Go to househack.com, learn everything about a startup that I'm creating, and really what we're going to do in short is we're going to be buying the dip on real estate. Big investors are getting big bulk discounts on brand new construction, wedge deals basically, and there are plenty of deals and foreclosures that we're already starting to see in the market, and we're excited to start buying next year when we think the deals will be even better. And if you want to join us in that and get founder shares at no upfront dilution, make sure to check out househack.com if you're an accredited investor. If you're not accredited, stay tuned. We're working on non-accredited investors. So can Elon Musk still cancel his deal to purchase Twitter? And will it finally stop the pain over a Tesla stock, whether he cancels or not? Is there a potential scenario where Tesla stock just gets hammered no matter what happens? We're going to talk about both of those questions in this video. Hey everyone, Meet Kevin here. Let's get started with, can Elon Musk still cancel? So the best thing to do to answer this question is simply to go to the cancellation rights in the contract. Here you go. Well, here is the glorious section of the contract that tells you exactly what happens in the event that Elon Musk is able to terminate and for what reasons he's able to terminate. There aren't many reasons. As long as Twitter fulfills their obligations, which obviously there was a whole court battle about that, which hasn't completed yet, but clearly at this point it seems like Elon's kind of taken the L on that court battle. So far at least, hey, who knows? We're going to assume right now that we're not going to relitigate the entire court case. We're just going to look at this cancellation right here. And the cancellation right creates three ways that Elon Musk could terminate the transaction. However, in the event he terminated the transaction through one of those three ways, he would be required, parent in this case would be Elon Musk, will be required to pay Twitter a termination fee of $1 billion, okay? And that states here that, as described above, if the conditions to parents and acquisition subs obligations to complete the merger are satisfied, and Elon Musk basically fails to consummate the merger as required, including because of the following: equity, debt, and or margin financing is not funded, Elon Musk, parent, will be required to pay a termination fee of $1 billion. Now, this is really interesting because at first, I thought the three reasons he'd be able to cancel would actually just be two. It'd basically just be if margin isn't funded or debt isn't funded. But let's break these down one at a time and see where there's an interesting potential loophole, maybe for Elon Musk. So first, debt financing isn't funded. Elon Musk right now has about a $13 billion loan commitment from Morgan Stanley. And it is one heck of an expensive loan, or at least it has gotten very expensive. Here is the section that talks about the interest rate from the debt financing commitment letter. And it shows us that Elon Musk pays approximately SOFR plus 4.75 or 4.5. Let's just go conservative and say 4.5% as the spread on top of whatever SOFR is. Well, SOFR has exploded. It's gone from about 30 basis points to over 3%. That means the following, which I found on Twitter from this person at RealMeetKevin. Think interest rates going up hurts? Just ask Elon Musk. His $12.5 billion loan, approximately 13, right? This is kind of where people round it, from Morgan Stanley to buy Twitter now costs him an extra $375 million more per year, thanks to rate hikes. Every single year, $375 million more. That works out to over $1 million per day in extra interest just to do this deal because J. Powell raised rates, okay? So worth noting, this is expensive. But according to the opposing counsel, and again, this is according to opposing counsel, okay, so it's probably a little biased, but as of September 12th at least, they argue here that not only is the agreement not terminated, but the bank commitment and equity commitment letters still remain in effect. Now that is actually really important right there, because if that is true, that debt financing and equity financing commitments are still in effect, and Elon Musk has already canceled his need for margin financing. He killed that. Rather than using Tesla stock as collateral, he did the next best thing. He just sold his Tesla stock, and now he doesn't need the margin anymore. Obviously, that created a lot of selling pressure on Tesla stock. But anyway, So according to at least the defendants, the Twitter attorneys, the debt financing commitment letter is still active and the equity commitments are still active. However, this is where things get a little bit interesting. When it comes to the debt commitment, I pretty much agree, because the debt commitment actually says that the debt commitment doesn't expire until the outside date of 6 months after 4/20 when the deal was originally inked. I know, it was inked on 4/20. But anyway, that means October 20th is when the bank could actually renegotiate this loan. And I have a suspicion the bank would love to renegotiate this loan. That's because interest rates have moved in such a terrible direction that, and it's very difficult to get third parties to do unsecured financing deals right now, deals that aren't like leaned up against the actual underlying property, that the bank might end up being on the hook for this loan in terms of holding the loan. See, you got to remember, companies like banks that put these deals together, they get usually 1 to 1.5% in advisory fees on these deals. On a $44 billion deal, that could be like, well, quite frankly, somewhere around $400 million in advisory fees for this deal happening. So, like, the banks are going to make out like bandits in advisory fees, but they're potentially going to get reamed on that $12.5 to $13 billion of debt financing, because usually banks don't actually want your loan. Like, people keep thinking, oh, the interest rate is higher, like the bank's gonna make more money. No, the bank does not want a book of loans. What they want is to write a loan going, hey, you promised to repay this money, right? Okay, here's the money. All right, now I got a promise to repay. Now I'm gonna maybe securitize this by bundling it together with a bunch of other loans and then slicing it up into 1,000 little slices and selling it as bonds to, corporate bonds to some Swedish investor or something, and I'm sure everything will be fine. Nothing like 2008. But anyway, banks don't want these. What they want is the fee for doing this. It's basically what you're doing is it's kind of like syndicating real estate, but it's syndicating loans, okay? The bank doesn't actually want to take all their cash and tie it up in an unsecured loan, especially since that can lead them to have to take mark-to-market write-downs on their earnings reports, which leads to a lower earnings per share for the quarter, and then that looks bad for the executive staff, and it just looks like a bad deal all around. And it's generally not something banks want a lot of on the book anyway, because it creates too much risk with the central banks, and the central banks are like, if things go bad, that loan could go bad, and then now that adds to more stress at your bank, and then if you're too big to fail, we have to bail that out, and we don't want to do that, so we might tell you have to get rid of that. And if you have to get rid of that loan that you're holding, well, we don't really care what you have to sell it for, just take a big loss and get rid of it. Okay, so like long and short of it, like the banks would probably love to bail on this equity, or rather this debt financing commitment, because they're gonna lose probably more money than they're gonna make on advisory fees. The problem is they committed to this deal until October 20th. Now, they could renege on that, but that would probably at least slay their reputation on Wall Street. It's like your commitment letter is basically now worthless because you just weaseled out of it at the last minute. So I think the banks are kind of on the hook with this one. So I don't think that debt financing isn't going to get funded. I actually think that debt financing is going to get funded. The margin financing isn't an issue. And so really the only potential loophole here is that something squirrely happens with that equity financing commitment letter. Now, the equity financing, some of that money is coming from Elon Musk, but some of that money is coming from other people, like the following. Firms like Apollo Global Management Inc. and Sixth Street Partners had been in discussions to contribute billions of dollars via preferred equity stake before Musk declared the deal dead. This is from Bloomberg. Musk had been looking to raise as much as $6 billion from preferred equity investors as a way to reduce the amount of cash he had to provide himself to do the deal in the transaction. Financing for the transaction includes about $13 billion of debt led by Morgan Stanley. We already talked about that part, right? Now, Reuters, via Bloomberg, is reporting that Apollo and Sixth Street are no longer in talks with Elon Musk to provide financing for the deal. There's talk on Wall Street that they were never even really interested from the get-go, so maybe these two companies are just straight up clickbait trying to get their names in headlines, and maybe these two companies didn't even matter from the get-go, and that the other companies who are providing money for Elon's deal are actually still interested. I don't know, but it's possible that maybe some of those other companies aren't actually interested. We'll see. So now you've got a really interesting problem because you're sitting in this world where, okay, well, the debt financing is probably going to happen. And quite frankly, if Elon Musk wanted to like weasel out of this deal, why would he make this commitment to do the deal 16 days before the debt financing offer would expire? Oh, and the likely reason for that is the court date was set for October 17th, and that is a trial date, which means Elon Musk would have had to have gone through depositions before that trial date on the 17th, then the trial date would have occurred, and quite frankly, as of October 5th here at 10 p.m. California time, the Delaware Chancery Court on Wednesday said that neither side has yet asked to pause the case, which is really interesting because then it makes you wonder, what if this is all like a big charade? Like, what if Elon's like, okay, I'll keep going in with the deal, and then even if you go to court on the 17th, you know, would the court case be done within 3 days? Or could you in court say like, hey, Your Honor, I said I'll complete the deal at full price, you know, we just need some more time, kick the can down the road a week, and now your debt financing expires, boom, $1 billion termination, walk away. I don't know, this is not as clear cut and over as some folks are trying to make it seem. Remember, if he cancels under either debt or equity not being available, it's a $1 billion termination fee. And the benefit to this $1 billion termination fee is, let's be real, he probably saved like $20 billion, okay? That's because on a price to sales multiple, Twitter is selling for twice the sales ratio of Snapchat and Facebook. Twice the valuation on a price to sales basis. And now, if you go to price to earnings, it's even worse. I mean, you're paying over 70 times 2022 earnings for this company, when you have other companies like Google trading for 10 to 15, Apple trading around 30. I mean, even Tesla, with what many think is a high valuation, is trading for like, 55 to 60 times earnings in 2022. Twitter's getting reamed here. And it's not only, well, I mean, Twitter would be getting reamed, right? Like Twitter's valuation should be getting reamed. But it's not only the fact that multiples have completely collapsed in the market, but advertisers have pulled back a lot of money from advertising. So earnings per share at Twitter are probably collapsing as well. In fact, their last quarter was terrible. So Elon's kind of overpaying for this deal and paying $1 billion fine. And I mean, when I say he's kind of overpaying for the deal, I should clarify that and say he's really, really overpaying for the deal, okay? It's so bad. It's so bad that you literally have Barron's on the front page of Barron's running, Elon Musk is overpaying for Twitter by a huge amount. Here's the math. Okay? So like, don't just take my word for it. It's like, do the math yourself. And it's just like, ugh, terrible. So Elon would benefit from just walking away from this deal, even if it cost him $1 billion, because $1 billion loss would be a lot better than the loss in valuation he's going to suffer for actually owning this company. Now, the thesis is that, hey, well, if he can, incorporate this as part of his X holdings, or maybe he, as he's alluded to on Twitter, he can create a future app like an X.com app or whatever that maybe is like a WeChat or subscription and payment model, and it's somewhat decentralized and it's got free speech, but it's got public moderation for that, whatever. If he can do all those things and he can grow the user base to 1 billion users and monetize it in a better way, great. But you still overpaying right now. It don't change the fact that you're overpaying by a lot right now, okay? Now, is there the potential that any of this creates some more stress on Tesla stock? And the reality is yes, absolutely. So first of all, we know that Elon Musk needs to come up himself with approximately another $2 billion. So Elon Musk's got to come up with an extra $2 billion. But we don't know the details of the equity financing agreement. But if the top two are good, let's say debt financing and margin financing, let's say these are not considerations anymore. But what if that equity financing says that whatever he can't raise comes from Elon Musk? Well, if Elon Musk ends up being $5 billion short on equity financing, it's entirely possible Elon might have to sell another $5 billion of Tesla stock, which could create $7 billion of selling pressure on Tesla. Now, a really dirty scenario could be, what if they go to court and then the debt financing expires and then the judge says, too bad you tried to play a game, letting your debt financing expire. I'm gonna make you come up with the money anyway. That could be another $13 billion that Elon has to come up with. That would just be like the worst possible potential scenario, but could happen. Now, those are short-term gyrations in selling pressure. In the future, Tesla should go back to a more fundamental based valuation, one that's not based on fear over China or fear over deliveries and demand evaporating or fear over Elon selling, which he could in theory through a 10b5-1 plan, even through the lockup period here or the blackout period before earnings. They could have prescribed a plan for selling this extra $2 billion, right? So yeah, you absolutely potentially still have other dangers and risks coming for Tesla stock. And a lot of it, I think, is going to hinge on, is that extra equity financing going to happen? Or can he somehow get things to delay to the point where the banks end up bailing on financing and then, oops, sorry, we played the game, waited 16 days, here's your $1 billion cancellation, goodbye. It's just, if some of his equity partners don't come through because valuations went to poopy doopies, and maybe they don't want to overpay either, does that potentially mean more selling pressure on Tesla? And the answer there is yes. Anyway, thanks so much for watching, folks. And as usual, we'll see you in the next one. And check out househack.com and invest with me if you're an accredited investor. Househack.com. Just bring your Invest Ready letter. Remember, that's househack.investready.com to get your letter and upload that at househack.com.